We can talk about Brandon Turner's opinion that rentals don't work. We can talk about the SLO Report. We can talk about WeWork's bankruptcy. That and more in your daily financial news. Folks, let's jump into it. Let's talk about good old Fed President Goolsbee. Goolsbee is laying out some facts that you and I need to pay attention to. Fed President Goolsbee is saying things like inflation is on a path to drop as fast as it did in 1982. Now, most of you have not looked at my 53-year spreadsheet, which again, we give away for free at onerentalatatime.com, so go get it. Why is 1982 inflation drop important? It is the fastest in a non-wartime environment. The inflation rate dropped 4%, 400 basis points in a single calendar year. Fed President Goolsbee is out talking about we could be on the path to repeat that epic drop. Now, a lot of that drop will ultimately have to come from housing. You and I have talked about shelter inflation for quite a while now. There is another 4 or 5 months of certain drop in shelter inflation. But we've also seen gas and oil roll over. If you haven't checked oil, I checked this morning, it's down under $80. I think it was at 78. So we are seeing, frankly, the economy slow down. We are seeing inflation drop. It is not my call that inflation will drop that fast, but it is important to understand if it does, what happens. Remember, one of the things that you and I have been talking about, and we're trying to wrap our head around, is real rates. The Fed, they never say this, but based on past performance, they want to have real rates be about 2% or 200 basis points. Okay, great. What does that mean? Well, if you assume inflation today is 3.5 and our Fed funds rate is 5.5, you have a restrictive 200 basis points. But again, let's play Fed President Goolsbee's scenario out. Let's say in the next 6 months, inflation goes from 3.5 to 2.5. With me so far? What happens to real rates? Well, folks, it is just math. Real rates will go from 200 basis points to 300 basis points, aka 50% more restrictive. The Fed doesn't want that, certainly if the economy is slowing down. So yesterday I talked with Taylor from Life Goal Investments, and he let it drop that the market, the smart money, is currently pricing in four rate cuts, 100 basis points. Yesterday when I heard that, I was shocked. But as I hear Fed President Goolsbee talk, I could see what the market is seeing. So again, will we have rate cuts next year? Maybe. Certainly if inflation falls, it's just math, right? Real rates stay at 2. If we fall quickly, they could be seen cutting at the edges. Also, could the Fed cut rates to spur economic growth? Absolutely. If we get inflation drop and we get unemployment rising and we get a weak economy, guess what happens? So again, it will be interesting to watch. The economy certainly appears to be slowing down. That ISM data from last week was eye-opening. We've seen GDP now whack Q4 estimates in real time, about 100 points or 100 basis points. So definitely some stuff to watch. But go ahead, if you have the spreadsheet, go ahead and take a look at 1982, 1983. Ask yourself, what happened to the stock market? What happened to the unemployment rate? What happened to housing? Right, folks, you have the data. It's all sourced from St. Louis Fed, all these other data sources. Go look at the 53-year spreadsheet today and just ask yourself, if Fed President Goolsbee is right and inflation drops, what else happens? That's why the spreadsheet's important. It is not a guarantee by any stretch, but it is an indication of what happened last time. I think that is valuable. Go take a look. Brian Lebo, gotta love Brian Lebo. Brian Lebo is a great guy. He was my agent to help me purchase my property in Vegas this year. He puts out monthly housing data on Vegas, and he's so entertaining. And he has receipts, right? Because he's been doing it such a long time. What did Brian say about October? Well, it wasn't pretty. It wasn't pretty. October home sales, aka transactions, fell again. 1469. It fell year on year. Why is that important? Well, folks, last October was one of the worst years ever in Las Vegas. So to see that October closings this year was worse than last year is no bueno, not good. It was an ugly month for Vegas real estate. So again, transactions 1469, and just cause, how does that compare to 2019, right? I like to use 2019 as Brian does because that was pre-craziness, pre-2% mortgage rates, pre-nonsense. In 2019, they did 2671, 2,671. So like for like, transactions are down 45% in Las Vegas. Again, a transaction crash. What about prices? The doomers and the crash bros still don't get it after 2 years of being wrong. You can have a transaction crash without a price crash. So what happened to Vegas pricing? Again, remember, nothing is selling. Prices have to be falling, as they would want to tell you. Well, folks, prices month on month were flat. Ready? Ready. Year on year, up 3%. Vegas real estate is up 3% year on year. Told ya. Told ya. So again, lots of stuff going on in Vegas. Why is Vegas important? Vegas is one of those markets around the country that things happen first, and they happen in a big way. So again, what would I say is happening in Vegas? Transaction crash, stable prices. That's where we are. So again, it'll be interesting to see what happens if rates fall. Does demand come back? All of those things. But definitely entertaining. I don't know if you saw this, but let's just say the three amigos or the four Avengers, Millennial Mike, Dion, the Lumberjack, and I were on some, I don't know, not tweets, but text message thread yesterday. Brandon Turner went on Ryan Pineda's podcast and said, rentals don't work. So I want to ask you, this channel is an investment channel, is home ownership. I want to ask you, my thoughts on Brandon Turner are well documented. There's actually a video I created talking about my beef with him. So we won't rehash that, but I want to know from you, do rentals work? I'll share my thoughts on that later, but you guys let me know. WeWork, wow. WeWork is in the news again, folks. WeWork has officially declared bankruptcy. As I think back to this channel 5 years ago, WeWork was one of those things we really talked a bunch about, what it was doing, the crazy valuation. They were once valued at $47 billion. $47 billion. But they had to go bankrupt. Why did they go bankrupt? Why did WeWork have to go bankrupt? The simple answer is to break their leases. Bankruptcy allows them to break their leases. WeWork went out and signed up crazy leases for long durations at the peak of the market, and they're losing money. The only option they had was bankruptcy. Bankruptcy will be messy. Bankruptcy will be painful. But I suspect we will be hearing from WeWork again, either in an acquisition or as a smaller yet more focused entity in 6, 9, 12 months. This isn't the end of the WeWork story, but it is an inflection point. It will allow them to get lean and mean. It will allow them to dump bad leases, and we'll see where they go from here. Because if you think about what WeWork does, right? It creates flexible space, small. It actually is perfect for this environment. It's just that they had all this overhead and bad leases. It was just bad timing in stupid expense structures, just dumb expense structures. But there we go. So we'll probably hear from WeWork again. Now the SLO Report. I've been doing this for 30 years, studying real estate in depth for over 20, and I can tell you until this year, I never looked at the SLO Report. What is the SLO Report? Senior Loan Officer Opinion Survey. That's a mouthful. What does it mean? What is going on with lending? What are banks doing with lending? So in short, it's a very detailed report. It talks about HELOCs and commercial loans and residential loans and demand and credit standards and all of this. To net it out, standards are tighter across the board. Demand is down across the board. Interesting. But the most important part when you understand how the system works is, what does that mean? It means the feedback loop of lending, excuse me, the feedback loop of lending, aka the lubrication of the economy, is drying up. When banks lend less, there is less investment, there is less transactions, there is just less of less. We are going to see the economy contract. We are going to see businesses go out of business. We are going to see business go bankrupt like WeWork because they can't get loans. We are going to see people sell for pennies on the dollar because they can't get loans. We are going to see less residential building. This is my fear. We talked about Goolsby earlier and this golden path to lower inflation. I agree. It's a mathematical certainty over the next 4 months or so. My fear, because if once that's over, and again, if we have less building and less, development, we come into next spring selling season with even less inventory, less new construction. What happens to prices? Could prices skyrocket next year and thus reinvigorate owner's equivalent rent and shelter costs? Could this be the crash up or the melt up scenario that Joseph Wang talked about on this channel last week? Fed guy. If you haven't seen that video, go watch it. You actually saw me get physically scared about midway through that video. It's possible. It's a frightening scenario, but it is certainly possible. SLO Report. 4 rate cuts. We talked about that earlier. The market, and this comes from Taylor from Life Goal Investments. The market is expecting 4 rate cuts next year, 2024. So I want to ask my audience, you can just put a number below, 1, 2, 3, 4, whatever you want. How many rate cuts will we have next year? I want to see what my audience is thinking. Leave your comments below. It's 2024 could be wild. Could really be wild. 2008. I got some notes the other day that people are starting to feel like it is 2008 all over again. And I don't see it. I don't see it. Most of these folks, when they talk about 2008, in my opinion, are referring to the Great Recession. They are referring to single-family homes. I don't know what to tell you. I don't see, being someone that invested from 2002 to 2008, who saw the wild lending standards and got out of the way, I don't see it, folks. Now, if you're talking commercial, you're absolutely correct. We, the banks, financial engineers, new investors got stupid. We got high on our own supply. We thought money grew on trees. We didn't do the work. We bought at stupid cap rates. We made stupid assumptions. We had horrible lending structures. If you're talking about commercial real estate mirroring single families from '08, I will give you that. And I talked to Ken McElroy about that as well. But I do think most people that watch my channel, certainly most of the people that comment, think that the single family housing market is going to repeat 2008. And folks, I don't see any similarities. None. For example, when the market cracked in '08, demand rolled over, never to come back. Not never, but you know what I mean. But more importantly, supply kept coming every week. The biggest difference between today and 2008 was supply. Go back and look at the charts of supply. Supply went up in almost a straight line. What is happening today? Supply is flatline, not 2008. And then lastly, I don't know if you guys have seen this, but Grant Cardone is talking a lot about the new FHA guideline. I think it's like November 18th, where you can buy a fourplex with 5% down, triplex 5% down. I was just part of a Central Valley real estate discussion on Friday, and I did some research. I have never seen fourplexes and triplexes in the Central Valley be this scarce and that expensive. I really do think that this 5% down, this house hacking fourplexes and triplexes is going to dramatically increase the price of duplexes through quads. Please do me a favor if you are looking out to do that. Do the math, do the work, don't overpay. Make sure it is you can afford the payment, right? You're still a landlord. You're going to still have 3 tenants. The stuff was still going to break. Don't get into a bad deal just because you can, right? Just because the bank will do the loan doesn't make it a good deal. I will remind you, in my first book, One Rental at a Time, one of the first mistakes I made was taking a cash out refi that turned my positive cash flow property into an alligator. Don't buy bad deals. Just because you can buy a fourplex with 5% down doesn't mean you should. Do the work, do the math, make sure you understand the numbers. Please, do the work. And then lastly, as I indicated last week, the course, How to Get Started One Rental at a Time, which is currently only $399, it will go up to $499 on January 1st. So I want to do a November special because I want you doing the work right now. If you buy the course now for the whole month of November for $399, I will give you 2 free $50 courses. You could get the Buy Box Deep Dive. You can get the ORAT Mastermind. You could get the Legends of Real Estate. Whatever you want, you could get those 2 free courses. So do me a favor. If you've had any interest, buy it now, save $100 and get $100 in goodies. And you'll be able to join the Facebook group, get around thousands of other people doing the work. It is the place to be. So folks, at the end of the day, I think Brandon Turner is wrong. I think he is biased because he can raise a lot of capital. That's what I think we're seeing. When you saw Brandon Turner's interview with Ryan Pineda, I think what he is telling us the little guys, hey, I can use my name to raise 9 figures in capital. I sell millions of books. I have raised $100 million in LP money. I can do big things. I need to place all this capital. So that's what I think he's telling us. This little stuff, he doesn't look at. That's what I think Brandon Turner is saying. But again, let me know what you think in the comments below. Is Brandon Turner right? Rentals don't work, and you should give all of your money to him so he can invest it. Let me know what you think. Bye.